Hello, I'm Ferris and this is my presentation, BADM 499, the use of banks versus the use of credit unions. Which one is the better deal? Research outline. With the introduction, where I introduce the research and researcher, go over our research objectives, our variables and definitions, literature review and variables, hypotheses, methodology, limitations, data analysis, interpretations, implications, recommendations, and finally the conclusions. Research and researcher. I'm Ferris, James, and Grant. This research is on the bank versus credit unions, looking into definitions, differences, comparisons. This is a comparative analysis based on international and local research. I'm going to use primary data for surveys and secondary data, including financial statements of both of these types of institutions. Study aims to edify, clarify, and to add to research. Problem statement. Banks and credit unions have been two staples of the financial institution sector, providing numerous primary and intermediary services. Both institution types offer very similar services with fluctuating nuances and contrasting cultures. Though larger banks may be presumed to provide a better advantage for the average individual, this large scale of operation may come to a greater cost for customers. The question rises, which of the two institutions enables an individual to be more economically viable and versatile? General objective is to determine which financial institution provides more economic value to the aggregate population. Specific objectives emphasize contextual difference and evaluate consumer preferences. Now we look at our independent variables, our household financial sentiment, which is the aggregate index of consumer sentiment, consumer expectations, the outlook of the finances of a household from 1 year ago, a year ahead, and then the national conditions of the country 5 years ahead and then within the next year. Other dependent variables: quality of loan, interest on loan, collateral, payment period, procedure formalities, documentation, sanction time, communication, e-services, and social media presence. Of course, you have independent variables such as age, your demographics, such as age, income, and education. Small bank, or in this case, the credit union share. Large bank share. Small bank access, which is the credit union access, and the large bank access, which is just the bank access. Borrowing variables are foreign ownership and management quality. Literature review. This is where our variable comes from. For the most part, these articles cover the specifics from an international standpoint, the specifics of the results gathered from using these different variables to sort of identify small bank and large bank. For example, small bank and large bank outlook for the customers, and different variables here. Okay, we have our hypotheses. Hypothesis 1, credit union customers exhibit marginally better customer satisfaction. Hypothesis 2, credit unions provide better utility by providing lower interest rates. Hypothesis 3, banks have a larger institutional share and access than credit unions. Hypothesis 4, credit unions and banks are not significantly different in terms of profitability. Hypothesis 5, banks demonstrate better management quality. Now, these hypotheses are derived from, of course, the international studies from literature, because there was a lack of literature specific to the Bahamas as it relates to banks versus credit unions, or even non-profit versus banks, small banks versus large banks. There was nothing I could find as relates to financial institutions and compare them within the Bahamas. This is our framework. Okay, management quality, which corresponds with hypothesis 5. Credit union or bank market share and access, which corresponds with hypothesis 3. Profitability, hypothesis 4. Reliability and communication, this is from the customer perspective, representing hypothesis 1. Service value, representing hypothesis 2. And aggregate customer satisfaction, which is representative of hypothesis 1, which should bring us to our optimal institution. We have our research measures, our different variables. Those. Methodology. Primary comparative research of all banks and credit unions that was done using financial statements. Delivery of questionnaire using Google Forms. And data analysis used was correlation, regression analysis, and ANOVA analysis. Limitations of the research: financial knowledge of respondents, insufficient sample size, lack of previous research studies, limited access to data, time constraints, conflicts from cultural bias, implementation of the data collection method, and scope of discussion. Now, the data analysis, consumer use and satisfaction. Right, the original yield of the survey was 155 respondents, but it was filtered to 122. I removed every response that did not completely speak about the institution satisfaction and the sentiment of the country. Of the 122, 69 stated that they use a bank as their primary saving institution. 53 stated that they use a credit union. Primary loan supplier, 97 responded with a bank, and 25 said that they would use credit unions. Based on the survey ratings, 90 elected to rate their customer satisfaction on a bank, while 32 decided to use a credit union. Now, the results from the consumer use and satisfaction. As we can see, let's look at the analysis of value variables. You can see an R square of 0.08, which is a poor fit. However, we have a significance of 0.001. Although that significance says that the X and Y variables have some relation, the poor fit didn't allow me didn't warrant me to do any further analysis because of the poor fit. Very poor fit, actually. Again, the same thing goes for the analysis of communication variables. Now, the value variables included interest rates, the repayment period, loan amount, and the communication included speed of the loan, and that came from value. Communication included communication with the loan officer and comprehension of the process. As we can see, both of those for poor R square, but the significance seemed to bear that there was a relationship between whether someone chose a bank or a credit union and the results of their satisfaction. A further analysis was done on the correlation, which also proved that there was no real relationship between the persons who choose bank and what their rating said. Of course, correlations that were expected were shown on the correlation matrix, such as income and job title. So we expect those two to correlate, but there was no significant correlation, notable correlation, between whether an individual uses a bank or a credit union and their satisfaction. Monetary value. Now, using the banks and credit unions, we discovered that there are 6 banks within the Bahamas. I did not look at private banks that dealt with personal banking, like investment, or commercial banks. So if we would remove all of those banks that exclusively do that, we are left with six. Retail banks and 6 credit unions. Now the loan information for those, the rate information for those, for all 12 of those entities were limited, so I was only able to get 4 of those, 4 each, sorry, which is a total of 8. And I used the mid-range of the interest rates provided, and we can see that the bank mean is less when it comes to mortgages and consumer loans, and the credit union mean is less when it came to auto loans. Management quality and profitability. Management profitability can be discussed or can be derived from the return on assets. This is basically the reported net income divided by the total assets. So you can see Royal Bank of Canada had a 5.5% return on assets, while Scotiabank had a 1.9%. Meanwhile, the 2 credit unions in the sample was 0.26 and negative 0.44. Another challenge with using this was that I observed that credit unions were reluctant to give out their financial information unless you were a member. However, a few of them had their information for public access, while all of the banks had their information for public access. The earning assets to total assets ratio depicts how well management uses the earning assets of a bank against their total assets. And you can see that they're pretty comparable, where the bank's RBC is 89 and Scotia is 87. Credit union 93 and the national workers is 86. So earning assets are things like loans, any investments, things like that, but it's not included cash, not including equipment, and not including any fixed assets. Credit union bank market share. Now we see the 6 banks and the 6 credit unions that I referred to earlier. The banks have 80% of the market share. This is just the number of banks divided, the number of banks for one institution divided by the total number of branches. So the number of bank branches divided by the total amount. So you can see majority of banks have over 10 branches, while the majority of credit unions have about 2. The most being National Workers Credit Union with 5. Of course, the banks have a more broader reach as it relates to islands, because they cover more islands, whereas the credit unions cover very few. The interpretation of the findings. It was disheartening, realizing that there was not a strong correlation between the use of the bank and the credit union and the variables I decided to use with such a low R-square, but the significance was low, which means that there is some relation, but of course the it would probably not fit the equation, so maybe a stronger variable should be used, or stronger questions. And the other interpretation is that perhaps banks and credit unions are too homogeneous. The interpretation from the monetary value results should be taken in reservation, of course, because there are so many things that go into what interest rate a person will be charged. Their down payment, debt equity ratio, what the purpose for the loan is, credit rating, things of that nature. And then credit union, bank market share, and of course banks outperform as expected. The implications, like I said earlier, banks and credit unions may be too homogeneous to the average Bahamian customer. And of course, like I said, the inconclusiveness was supported by no correlations regarding the survey. And one of the strong implications that perhaps banking is an individual experience and it's probably harder to quantitate because um, the experience may also occur less frequently than another experience. Like you may go to the gas station every week or the food store once a week, but getting a loan or doing some extraordinary transaction at a bank or credit union may occur too infrequently to properly be quantified and to be properly be compared with another institution. And then there's another supplemental question: if banks consider credit unions as threatful competitors, just based on the amount of respondents that say that they use banks, and of course their bank market shares. Recommendations: identify if heterogeneity exists in the average customer. Utilize a wide array of questions and techniques. More comparative structure. Obtain all financial information, including complex calculations of all fees and charges associated with servicing, opening, maintaining an account, and initiating any mortgage or loan service offered. Conclusions based on our hypothesis. Inconclusive, hypothesis 1, remain inconclusive, as well as hypothesis 2 because of the restricted amount of information, although banks seem to perform better. Again, like I recommended, that there should be more calculations as relates to all the fees involved and more surveys as relates to capturing exactly what individual rates, because if a bank can advertise that they have as low as 4% for a mortgage, but rarely sanction a mortgage at 4% interest rate. Banks have a larger institutional share. That was a gimme, so we failed to reject that hypothesis. Credit unions and banks are not significantly different. We reject the hypothesis because it appears that the credit unions in the Bahamas are true to their non-profit organization function, as opposed to those done in international studies that show that credit unions are as profitable, in some cases, as larger banks. And we reject that banks demonstrate better management quality because using the management quality ratio, we see that credit union management performs comparable with bank management. Thank you very much for your Thank you very much for your time.